Welcome back to HECM World Weekly's video podcast. Reverse Mortgage Daily's Chris Clow reported that the reverse mortgage portion of FHA's Mutual Mortgage Insurance Fund has maintained and also reached a positive capital ratio for the third time, in fact, since 2015. Now, that is according to a recent actuarial report, which is released each year for the fund's finances, and also FHA's annual report to Congress. Both were released last Wednesday. Now, the book's value sits at roughly $11 billion compared with $15 billion recorded in 2022, and that decline can be largely attributed to weaker home price appreciation, to which the fund is very sensitive, and that in fact was predicted in last year's report. But still, the health of the home equity conversion mortgage, or HECM, the portion of that book of business, does in fact remain strong as FHA sees it, and the economic value has increased while the portfolio actually has recovered from issues which previously put it on some shaky financial footing. Now, the report reveals that the capital ratio for the HECM portfolio comprises just 5% of the total MMI fund for FHA, and it fell to 16% in 2023. That's down from 22% in 2022. As expected, the financial performance of the HECM portfolio has declined somewhat during this fiscal year. However, the HECM standalone capital ratio remains positive for the third year in a row. Reverse mortgage veterans watching right now know that the HECM program's capital ratio is extremely sensitive to home price appreciation changes, positive or negative, and also interest rates, lower or higher. So when rates are going up, then we're seeing the program's total capital ratio being negatively impacted. And when we see home appreciation rates going down at the same time, that also would compound that effect. Now, the HECM program stands at about $16 billion in maximum claim amounts that was issued in 2023. And the HECM cash flow, the net present value in 2023, which is in fact a measure reported to Congress by the U.S. Department of Housing and Urban Development, was estimated to be about $6.7 billion, that according to the actuarial review. It should be noted the actuarial review found that the estimated economic net worth of the HECM MMI portion of the fund is a positive $15 billion, and that's an increase over last year. FHA Commissioner Julia Gordon said, "The fact is the HECM book is uniquely sensitive to home price projections, not just the actual numbers that we've had in the last few years." And there's good news when it comes to the availability of HECM counseling in the future. HUD's Office of Housing Counseling is making plans to improve the HECM counseling experience, but also to increase its ranks of HUD-certified HECM counselors, that according to a recent story in Reverse Mortgage Daily. David Berenbaum, Deputy Assistant Secretary for the Office of Housing and Counseling at HUD, made some comments during NORMLA's annual meeting in Nashville, Tennessee last month, and it really reflects the agency's prioritization of increasing the availability of HECM counseling. So he has been listening to feedback in the reverse mortgage space about the Homeowners Assistance Fund, or HAF, and that program was designed to give financial assistance to any mortgage borrower that was impacted by the COVID-19 or coronavirus pandemic. Berenbaum noted, "During the pandemic, we helped over 300,000 families apply for Treasury programs, the Emergency Rental Assistance Program, as well as the Homeowners Assistance Fund. It made a big difference. We heard about the role it played in concerning homeowners association fees, for example, or for consumers who had the reverse mortgage itself. Now, our counselors do a lot of very important work, and our office is monitoring their compliance with our program and also ensuring the quality of the program and counseling overall." It cannot be overstated that HECM counselors play a crucial role in helping reverse mortgage borrowers age in place and to do it wisely. And they do that by helping the homeowner understand their financial resources that are available and their responsibilities. In fact, we have an interview on that very topic that can be found on HECMWorld.com. HUD-certified HECM counselors and the department's housing counselors in general do not always receive the credit or recognition for their professional proficiencies, said Berenbaum. "Goal number one is to elevate the profession, and I do mean the profession of housing counselors," he said. Berenbaum said, "Too often housing counseling agencies are treated as charitable organizations, and their staff are not viewed as skilled professionals. Well, the certification of housing counselors has changed that game. Barenbaum suggested it's more difficult to pass the certification exam required for housing counselors than licensing exams in other areas, which is certainly true of the counselors that do provide HUD-certified HECM counseling. Now, while the Office of Housing Counseling does serve an estimated 1.2 million prospective mortgage borrowers in general each year, the goal of the office is to increase that number to 3 million households served moving forward. And one way they can accomplish that is through a change in the fee structure. Every dollar of HUD funding leverages between $7 and $10 of private sector funding from other programs out there in the world. And that includes work being done by agencies in fee-for-service because their time is valuable as professionals, and it's very appropriate for professionals to charge a reasonable fee, even in not-for-profit environments. And our final story for this episode, Americans are increasingly ransacking their retirement, says a recent AOL column. And the ravaging of the retirement accounts, in fact, is increasing. The number of participants who are now taking hardship withdrawals from their 401ks was up 13% in the third quarter of this year versus the second quarter, that according to a new survey from Bank of America. And they track about 4 million clients' employee benefit programs across the nation. Now that tallies up to more than 18,000 plan participants, and that's the highest level in the past 5 years since Bank of America began tracking that data. And that's up 27% when compared to the number of emergency withdrawals during the first 3 months of the year. Now, to be very clear, while these numbers have been increasing, they are still a very low percentage of the overall number of plan participants. But taking a loan from a retirement savings account is undeniably a quick way to get cash in uncertain times, but there are consequences. In looking at our data across 401k plans, economic hardships continue to be a factor, said Lisa Margison, Managing Director of Retirement Research and Insights at Bank of America. While there could be several factors at play, the economic environment following a year of high inflation and the rising cost of living could be influencing this ongoing trend. I would add that one of the factors that may be driving this disturbing trend may include the tightening credit standards of banks and lending institutions, resulting in many being turned down for credit cards, home equity loans, or cash-out refinances, which leaves them looking at their retirement accounts. Now, according to the Bank of America survey, the average worker hardship withdrawal from a 401k in the third quarter of this year was about $5,000, and that's on par with the average withdrawal in the previous quarter of this year. Borrowing from retirement savings was also up. The percentage of 401k participants who got a loan from their workplace plan in the third quarter was 2.5%, and that's the same as the second quarter, but up from 1.9% in the first 3 months of the year. And the average loan amount is $8,500, consistent with the average loan amounts that were borrowed in the first 6 months of this year as well. But here's what's interesting. The generations that have the highest percentage of loans from their 401ks were Generation X, 23%, born between 65 and 1980, followed by millennials, 15%, born between the years 1981 and 1996. But these loans, however, are not permitted from an IRA or from an IRA-based plan such as SEPs, SERSEPs, and also simple IRA plans. And that concludes another episode of HECM World Weekly. Thank you so much for watching. Be sure to subscribe to our YouTube channel, and we do have an audio version if you find that you cannot be watching but you want to listen while you're driving down the road. Definitely recommend audio in that case. You can find us on Apple Music and Spotify as well. Thanks again for joining us, and be sure to return next week for more reverse mortgage news on the go.